All right, this is an analysis of the energy sector, July 2, 2022. ENB is the company that the standard deviation portfolio is calling for. OKE is the sector leading MVP. EOG is kind of a utility player, has been in many of the portfolios containing the M score and alpha M score and up M score down, so forth. Valero is currently where we are, and DVN is kicking everyone's butt as far as price performance goes. So let's take a look at these guys and determine exactly where we're going to go, where we're going to be. So first things first, Valero price has gone way up, and so the dividend yield has come way down. Now, the interesting thing is we purchased this company at $50, so our dividend yield is actually about 6%. Same as these guys. But if we were to purchase more shares, we'd have to purchase more shares at a higher price, and that will mean that our dividend yield will come way down. And that dividend, as we have seen in many of the portfolios, is very important, especially in a down market. So I am really interested in these higher dividends. We see that EMB, which is what the standard deviation portfolio is calling for, does have the highest dividend, almost 8%. That's really great. And so really interested in that. The rest of these guys, I'll say, are average, right at that 6% range. But DVN, just because of its great performance, says a lot, when compared to the rest of these guys and the dividend. All right, PE looks like EMB is the most expensive, which doesn't make a lot of sense, but the fact that it is in that better performing portfolio, meaning that people are willing to put more money into this company for whatever reason, definitely want to look into why that may be. OKE or Valero rather, second highest, and then EOG and DVN lowest. Now, this DVN is interesting. The PE is really low, but we know that the price performance has gone crazy. And so if price performance is really high, but PE is really low, um, that tells me that what may be happening here is that the earnings have outpaced the stock price. Very possible. It's very possible that they're making just way more money and the stock price just can't keep up, but it's trying. So again, very interesting situation because low PE means that the company is cheap compared to its stock price and its earnings from that stock price. And so definitely something to take a look at. The 5-year high, 27 for these guys. Um, so everyone is pretty much off of their 5-year high, with the exception of Valero. That says a lot. It means that Valero is as expensive as it has been in the last 5 years, and that means that there's potentially only downside from here. It doesn't mean that the PE ratio can't go higher than what it has been over the last 5 years, but it means that it's definitely at the top compared to the rest of these guys. Okay, the 5-year low. Remember, there isn't really a negative PE, so we can't really look at that. But we do see OKE got all the way down to 4, EMB got all the way down to 12. EMB is closer to its 5-year low than its 5-year high, which is telling, I think. And then you see that OKE is definitely way more closer to its 5-year low than its 5-year high at 57. So that does say something. When we see this negative PE, it seems to me that these guys had a negative net profit. They were losing money at some point in the last 5 years. All right, average PE 24 for EMB, currently at 19 roughly, so a little bit under is average. Same thing goes for OKE, and we can say that uh, Devon Energy is at its average PE, which is interesting. Again, that is a really interesting story that I am really curious about. All right, net profit. We see that Devon has a better net profit than the rest of these guys. EOG second, and then ENB third. Now, I don't know a lot about these companies, honestly. I believe that Enbridge, ENB, is more of an oil company than it is a refiner gasoline company like Valero. So that may have something to do with why there's such a disparity in net profit. But with that being said, 33, 26, and 21 are similar, and Devon Energy really killing those guys there. All right, return on assets. All this stuff is what makes up that M score. And this is why it's important. Okay, this is just trying to figure out how the company is being ran, right? We just simply look at the total assets. This is going to include goodwill and just everything, right? And we see what the return of the stock has been, what the profit has been, and how that compares. And so we see that Devon Energy has returned, has made the most money with the assets that they have. Okay, EOG second in line with that. The rest of these guys are right about the same. Again, this may have something to do with the type of company, but the fact that we even have two of these guys in the same ballpark means that we do have some comparable information to go on. And currently, again, Devon beating these guys out. All right, cash on hand. Again, this goes back to the M score, the management score, right? More cash means more opportunities. It can also mean um, more opportunities to lose money too. When you have a lot of cash on hand, it may mean that you don't have anything worthy to invest in, or that management can't efficiently and effectively find things to invest in, and so they're just holding on to cash because they don't have anything else to do with it. Okay, we see that Valero has the most cash, but it does not have the better management score because of the other areas that they're seeming to lack in. All right, EOG second in line, and then again Devon Energy third. I mean a strong third too, right behind second with the 797. ENB and OKE don't have a whole lot of cash. Again, may have something to do with the type of company, but that's neither here nor there. Really outsized cash to debt ratio here, being that EOG and Valero and Devon are kind of similar as far as cash versus shares. When I look at cash over debt, that tells me that EOG does not have a lot of debt. They have a bunch of cash and they don't have a lot of bills. Compared with Valero and Devon, they're about the same, but Valero has a bit more uh, cash on hand. I will say, um, as far as the shares go, whereas Devon Energy appears to have um, more cash on hand relative to the amount of debt. And so there may be a discrepancy there with the number of shares that the company is either issuing or buying back. Okay. All right. Percentage short. This is not included in the management score. I have thought about including it because I do think that this does say something to management's effectiveness, right? If the market believes in this management team, they won't short the company. If they think that this management team is not doing well and that they are tanking the company, then that short interest will tick up, right? In this case, we see that all these guys are about the same. Devin does have quite a larger short interest, but that has everything to do with the fact that the stock price has ran up so much. And anytime that you have a stock price go up that high, you're going to have those that are going to say, hey, I think this has gone up too high. Let's short this thing. Um, that can be a bad thing. Sometimes it can turn out to be a good thing. But either way, I think this is a very natural um, data point here, and I don't think there's anything to really worry about as far as why the market is shorting this company more than the others here. All right, alpha. We know that the alpha companies we're going to want to stay away from. These are the companies that perform better when the market is performing better. And Valero meets that criteria. Then we have OKE, and then Devon, and then EMB and EOG are the worst. And so, you know, when things are bad, things are bad. When things are good, things are good. That's basically what this is saying. But over the last year, it appears that it is best to be cautious than it is to be aggressive as far as going after those returns. All right, up moves. When there is a lot of buying and selling, these companies tend to price tends to appreciate, move up versus go down. Looks like OKE beats everyone out, but everyone else is kind of right there with each other as far as that's concerned. EMB not good at all. Again, this just goes to show exactly what kind of company EMB is. They, I imagine, will have a much better beta. So let's see. All right, down moves. ELG beats everyone out as far as down moves. Again, this is when there's a lot of buying and selling. These companies tend to not lose as much money as the rest of their peers. Everyone is about equal there except for ELG. All right, beta. I expect the beta for EMB to be really big, and it is. Interestingly, though, OKE is right there. And what this means is that when the stock market goes down, these companies tend to perform better. Okay. Now, this is really interesting that OKE has a high beta, but it looks like it beats EMB on all these other categories as far as stock price performance. So that's really interesting. All right, 1 month return. This is on average what the monthly return is. It looks like OKE does beat that out. Now, this is not including the most recent year of data. This is going back from 2018 to 2021. So after July 2021, it does not capture any more data. The purpose of that is so that we don't want the data clouded by what's happening right now. We want a true historical depiction of what this company has done. And so we're looking 3 years between 2018 and 2021. This company has performed better than the rest of this group. That is not the case right now. We know that Devon Energy is performing better than all of these guys. But again, between 2018 and 2021, it was OKE. And so I think that says something. It says even more, though, that Devon was second in line only to EMB, again, what we're being called for. So far, again, Devon looking really good here. OKE looking good, too, from that defensive position, right? Devon looking really good from that aggressive money position. All right, so volatility, standard deviation. This is the portfolio that we're following, okay? And that's the reason why EMB, you see here, has the lowest number, which in this case is the highest number because we want less volatility, right? And Devon, of course, has more volatility, meaning that, again, when things are bad, they're really bad. When things are good, they're really good. And so while it is very tempting to go after that huge run up, especially in the energy sector, the question becomes, now that we see 80% of these energy names above their 200-day, none of them are above their 50-day. I mean, they just fell off a cliff. Do they come back? Does that 50-day average come back? Because right now it's crossed below that 200. That's what's considered a death cross. That's a very bearish signal. So I think that it is important to remain cautious, but at the same time, that 7% a month looks really good, right? All right, let's take a look now at the M score. ELG better, M score, Devon second in line. The rest of these guys, Valero's kind of third. The rest of these guys not really there. And again, we know that M score does matter, right? It does matter. A more of a defensive situation. And so at this point, I think that it is prudent to remain cautious. We won't go with Devon, but we definitely something that we'll keep an eye out on, right? Um, Again, looking at the return, looking at the alpha, knowing that these companies are not, performing well right now, even though OKE is the sector leading MVP, because I imagine that, like I said, when it's going great, it's going great, right? But um, again, with where the energy sector is, I think it is prudent that we remain cautious and not try to be too greedy. Um, So EMB is where we'll go. We're going to get out of Valero. We will sell at that 42% gain, and we will look at what shares we need for EMB. Currently, the price is 42.66. Uh, Great big dividend. Looks really good, and so we'll look at possibly trying to get that stock a little cheaper, and to get a larger dividend in that sector.